Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. This is a special weekend report, special coaching session that we're doing live, and I want to do this especially to answer any specific questions that my traders may have, and also to give you an idea how this whole magic comes about, so to speak. So. We're going to go right into the chart and pretty much take a look at the gold, at the December gold contract. And I'm going to come back to you here in a little while, and I can answer any direct questions that we have, but I want to focus on the chart, and what I want to show you, just to kind of give you a little preview or summary, is the transformation of the artificial intelligence that is embedded in the algorithm that we wrote in TradeStation C++ and C++ language. And I'm doing a reverse engineering, so to speak, process, because through the process, I personally, as a trader, as a self-directed trader, have learned a lot of things about me as a trader, number one, with regards to discipline, with regards to simply trusting the algorithm or the math of the market, so to speak, to make the decisions according to how you code it and according to the artificial intelligence. And one of the important things that I have learned is that it has allowed me to be completely objective. And to focus on trading without emotion, to trust the work basically that is underneath this and the composition, because once it proves itself, and we've been doing this for 12, 13 years, but it's taken a process of time to build the confidence in you as a trader, so that when you obtain the data, that you don't have to put in any emotion in it. Maybe it won't go, or what if, no, you become a robot. You become an executioner, which is what you should do. When the market is open, you should come into the market with your structure in place, with your system in place. You don't come in to analyze the market. There are, many factors that we found, obviously, that made the difference. And one of them is that the most accurate way to analyze the market for prospective trading is when the price is closed. Whether it closes on a 15-minute bar, or it closes on a daily bar, or on a weekly, when the price is closed, it establishes a set of circumstances that are based on a static code, a static algorithm. And the only thing that is movable, so to speak, and that has movement, is the price, the volatility in the market. And so the idea is that when the price, you allow the price to touch the levels, the pivot points that we use, and that activates your alert. It tells you, okay, we've touched it, it's a setup. And in what we found is, in using the 15-minute bar, it adheres to the entry point or to the short trigger extremely well. And when you're talking about probabilities and you're getting 95% probabilities, it's very hard to argue with that math. And so what I've done is I've come out of the emotional aspect of the market. I look at it as a business. For me to come in here every day and find an opportunity, and there are thousands of opportunities, it's a question of you as a self-directed trader creating a plan, identifying a market, identifying an instrument, and having a very definite structure with regards to risk management and money management. And when you have that model in front of you, then you're looking at it from a different point of view than trading at random, which 90% of people do. When I decided that I wanted to be in this business, basically I decided that I needed to do the work that will make me successful. It took a long time, I wish that it wouldn't have taken so long, but everybody has a turn, and the light goes on in you when it's right. And that's very personal. That's one of the things that I've learned about trading, is that trading is very personal. The decisions that you make are based on your emotional makeup, the objectives that you have, and most of us don't realize that we're working with fear, with greed, which are emotional aspects, and they are your enemies in trading. And so if we can kind of put them in a box where they belong, which is not in trading, and use the math of the market, and after so many years, understanding the basic function of the market is supply and demand. Whether you're day trading or swing trading or position trading. And so once you understand those dynamics, then obviously what I did for myself was to build the structure within that aspect of the market that is a scientific mathematical structure. And so understanding the function of supply and demand, understanding that no matter how far prices will go above a certain price level or to an extreme, the markets are like a rubber band. They extract and detract. And so we expand and retract into what we call the equilibrium. And that's the mean. That's the basis of the structure of what we trade. And so the structure, in using the perfect Fibonacci structure, we created 5 levels of pivot points. Within those 5 levels, we have an average price, and within that average price, we have the extremes above and below. That's the basic artificial intelligence and methodology, one of the aspects of using the VC PMI. The other, obviously, which I'm teaching privately in a one-to-one, is how does the artificial intelligence identify the trigger points? Most of us in the business have access to a lot of data, information, in some cases what I call false information. And if you decided that you are a technical analyst, which took me a long time because I was fighting between fundamentals and technicals, and I learned the hard way. Fundamentals don't work. They lag the market. They're manipulated. And what really I discovered through the process is that regardless of how manipulated the market can be, you can identify the energy of price action based on whatever unprecedented catastrophe or fundamental news come out. And that will drive the price to an extreme. In understanding the principle of the reversion to the mean, it really doesn't matter whether it's a fundamental or, a catastrophe that did it. Depending, obviously, on the intensity of that, it would push the price to beyond levels sometimes. Like, for example, it would push the price beyond the level daily into the weekly and into the monthly. So what we have done is we've pretty much have created a program that trades the 3 trends of the market. And within those 3 trends, we try to find the harmonic alignment that takes place using the independent data of the daily, weekly, and monthly. But when price comes to a par or a harmonic level or an even alignment, it identifies the highest probability to enter into a trade. And once you identify that, then what I'm teaching my traders is the artificial intelligence. When does the trigger point is identified? So coming back here to the room, I want to focus on the chart that you have in the room, and I want to show you basically the process that I go through as a self-directed trader, you might say, or the process of the automated algorithm if we reverse engineer. Okay. On the chart, you see on the left the daily information that already was programmed for Monday or Sunday night's trading. And in here, obviously, you see the Fibonacci structure of 5 levels if you just look at the daily numbers, okay? The average price that has been identified is 1482 as we come into next week daily, and the sell 1 level of the extreme above the mean is 1484. The sell 2 level is 1487. The extreme level below the mean is 1479, the buy 1 level, and the buy 2 level is 1476. Okay? Now, on the daily, because the price closed now, if we look forward for Sunday's night's trading, how do I read this for Sunday's night? And what I want to show you is also the transformation on the weekly, okay? And I'm going to show you how the code is written and how it transforms into a signal. Very interesting, and I thought I'd share this with you on a completely transparent basis so you can understand the frequency, how it changes when the signal is activated. On the daily, it's very difficult to do that kind of work, obviously, because it changes constantly. So understanding the artificial intelligence that it tells you that as we come into next week, the average price is 1480, and the price closing above at 1482.40 is coming into next week with a bullish sentiment or a trend momentum. Okay? The average price identifies the trend momentum or the sentiment of the market. And it has a 50-50 standard deviation. It can go either way. And so after being around for a little while and getting beat up, and identifying some trigger and opportunities here, I've learned that the average price is 50-50 standard deviation, and I want to take the highest probability trades. I don't want to get chopped up. You can trade it as a self-directed trader, you can make any decision at any time, obviously, but what I'm showing you here is how systematically the system shows you not only like a GPS where the extremes above or below, your destination, so to speak, but how you can use this and transform it and customize it into some kind of an intelligent portfolio that you can manage by trading the daily, weekly, and monthly signals. That's another aspect I will talk about, which is really risk management and money management. What I want to focus right now is in giving you an understanding of the process of transformation of the algorithm, how it changes and why it changes, and basically, how you read it. And so as we come into the day trading session on Sunday, you're coming in with already a sentiment that is bullish, right? The market closed above it, so you're coming in with a bullish sentiment. And as a day trader, you don't have a price. You don't have a position, I should say. And so you're waiting for, a trading opportunity. How do you identify a trading opportunity for day trading? Well, at least you're coming into the market, you know that the trend momentum is bullish, okay? So what I suggest is this, and I follow the same trading philosophy. I execute this myself. It's verified in Tocker. And I also am verifying that this can be used with derivatives. I'm doing futures in here, and we're applying it into a margin account, an IRA account, and a security stock account, and it works in the same way. And so what this does is that, for me, it tells me wait on Sunday to allow the price to do what it's going to do. On the daily, it establishes by closing above the trend momentum of 1482, it activates and identifies for you the sell one level of 1484. Okay? It also identifies for you the buy one level below the daily mean of 1479. Okay? And so the market either is going to go up to 1484, which is the one-to-one extreme level of the relative implied volatility one-on-one above the mean. And the algorithm identifies this with a 90% probability mathematically that if the signal is activated, like you see here, it will revert back to the mean and potentially at the extreme below the mean. I'm not sure how experienced most of you are, and you've heard W.D. Gann saying, what goes up must come down, or, if the market goes to an extreme above the mean, it more than likely will test the extreme below the mean. The difference here is that the algorithm and the artificial intelligence combined not only uses the pivot points, which is the basic foundation of this, but it identifies it with colors. It identifies the supply and demand level with colors. And so you visually now have an understanding that the price is at the average, it's bullish, but you want to wait until it goes either below the mean into the level of demand, let's say a buy one of 1479, okay, which translates to a 90% probability mathematically. The sell one level above and below the mean, which is 50-50 standard deviation, is 90% to the mean. When we get an activation, there's a 90% probability that the price will revert back to the mean, as you can see here. And I can show you many examples of this principle. And I'm sure most of you already have experiencing or are beginning to experience in how the market relates to these algorithms, to these levels. So not only do we identify the trend momentum, we identify the color, and it tells you if the price goes into red, it is entering what it's called a distribution of supply area. And it prepares you and it tells you, okay, if the price goes up again to 1484, there's about a 90% probability you're going to begin to find supply or sellers into the market, right? It tells you right off the bat. Knowing the color now, it tells me if the market comes down to 1479, there is a 90% probability that the price, if activated, would revert back to the mean. And that's the reason why the first bar is a setup when it touches the code, because you don't know where the price is going to go and activate it. So you let the market do it. And the algorithm is structured so that it captures with uncanny accuracy those extremes and reversals in price in the market using the 15-minute bar for day traders, using the 15-minute bar for weekly signals, and using the 15-minute bar for monthly signals. So, understanding that logic and principle now that you use on the daily, okay, we have a pretty good idea what's going to happen on the daily. If you take a look on the right of the chart, we have the weekly numbers now, if we take a look, okay, and the weekly average as we come into next week is 1480. The extreme level, sell one above the mean, is 1494. The second is 1507. Okay, that was, I believe, the numbers from last week. Okay, so I'm going to bring you into the world of updating the variable change in price momentum indicator. So now you have your numbers, you get your numbers, you have your password, you go to the website, right? You have your numbers, now you have your charts, and so you update these charts now with the weekly numbers. So I was in the process of doing that, and I didn't finish quite a bit. So I'm up to the sell one level, which is that 1486. And the sell to level is coming in at 1492. So automatically, what you see here when you're updating this, and I recommend to do it manually. I'm an old-fashioned guy, trader from the floor back in the 80s. So everything I did was, kind of manual during that time. Technology wasn't as advanced, and so it gives you a feel for the energy transformation that's taken place, and you can see now that the price, the resistance is coming down. It's coming down, lower, right? So you're getting lower highs and higher lows. If we look at the weekly now, in closing above the average price of 1480, we're coming in now with a weekly bullish trend momentum, or a bullish sentiment. When it identifies the trend sentiment, it activates the sell one level above now on the weekly, which is 1486. The sell two is 1492. The probabilities are the same on the sell one weekly of 90%. If the price is activated, it will revert back to the mean, or if it closes above it, I suggest traders do not buy. Even the signal has a 5% more probability to go up to 95, but from 86 to 92, that could, unless you do it multiples, and that's another aspect of coaching, which is money management, multiple management. You with me? And later on, we'll discuss how you use multiples and where you execute them. But in here, when the price closes above the sell one daily or weekly, it only has a 10% chance. It only has a 10% probability. So ask yourself, as a self-directed trader, do you want to take that trade? I don't. I want the highest probability, so I know that if activated, I'm getting a 90% probability, so I wait. I'll let the market do it. If the daily goes up above sell two, okay, then the system connects the next pivot point to the weekly as the target. And so once you identify the daily and the weekly, now you put it on your chart. Now you use the price action against the daily and against the weekly in determining, in building your position. As a day trader, you can use both, even if just as a sentiment. As a swing trader, obviously you can use both. So that is a personal choice that you make as basically you build your strategy, your portfolio based on your sizing condition. So coming back to the artificial intelligence of the market now, we have the weekly that's telling us that the trend is bullish. It's identified the sell one level of 1486. And it also identifies the stop below, which now we merge the two. It could be the daily below 1482, right? The daily average now is 1482, and the weekly is 1480. And the market is trading above the two of them. That's bullish. That's very friendly. But where do I put my stop? How do I manage my risk? Well, conservative traders can start using the daily in the same way that, we use it to execute. You can also use it as your protective levels, depending on how aggressive you want to manage your risk. The weekly signal tells you put a stop at 1480 below on the weekly signal. Based on the daily average of 1482, you can use that as well. You can also use the daily target. What's the first target? Is 1484. Now, as the market moves up to 1486, what do you see here? You see that 1486 is matching almost the daily 1487. So what is that? Once again, that's what we call harmonic alignment. And that relationship has a very high probability, if activated and confirmed, that the market could revert back from there. It's beginning to say that the supply now is increasing at this price levels on the daily and the weekly signals. Not to mention that the sell to level on the weekly is at 1492. So what you see here is the identification of where the supply is going to be as we come into next week. That's a tremendous asset as a trader. And the artificial intelligence will tell you when and if the trigger is activated. So this is where we are in terms of the next trading session for the gold market. And I'm focusing on the gold market just to teach you the logic and the AI, so to speak, of the algorithm, so that once you understand this process from neutral to active to target or stop and back to neutral, this is the methodology that you follow on the daily and the monthly, weekly and monthly. Okay. Now, what I want to show you here is that basically once I do the signals, and this is the CC++ easy language transformed in simple language, so that my traders can understand, so that I can understand, and I did this for myself so that I can see and read kind of what the algorithm is saying. And so what I wanted to do here is actually show you the information from last week. As we came into last week, the market closed at 1481 last Friday. And because we closed below the average price, the 9, and I also use here the 9-week moving price, the average, the 9-week average price, 1485, we're coming in bearish into this week. And this is the language. The market closing below the 9-day SMA 1485 is confirmation that the weekly trend momentum is bearish. The moving average also identifies the trend momentum of the market up or down. And this also tells you that, but even though it gave you a bearish indication, that a close above the 9-day moving average would negate the weekly bearish short-term trend to neutral. So now you have another tool that tells you 1485, a close above it, is saying the bearishness is going neutral. Okay, so you have that pivot point in mind. Also, the VC PMI coming into last week was 1479. And that's where you see it the whole week. I was trading that 1479 above or below. And the market closing above 1479 is bullish. So these are the filters of the algorithm. The weekly price momentum is the VC PMI, and it identifies the average price. And when the price is, when the market closes above it, it's bullish. And it tells you with the market closing above the VC weekly price momentum indicator at 1479 is confirmation that the price momentum is bullish. Be above it is the trend momentum. You see? And so now we're getting very specific into the trends, whether it's a price momentum or trend momentum. It's very, very specific. The average price, the mean, is the equilibrium. And based on the close, it tells you bearish or bullish. In here, the closing below, it's bearish and automatically activates the signals below or above. Because the price closed above the VC PMI of 1479, it is bullish, and it told you as we come into this last week, 1494 was your first sell one target. Your sell two target is 1507. And that this is the number that the whole week we were trading with the expectation that potentially the market may rally back up to 1494. And it also told you if we come down and close below 1479, or close below the VC weekly, it would trigger weekly stops and negate the bullish signal to neutral. It tells you look to take profits on shorts if it closes below at the buy one levels of 1465 to 1450, and reverse to go long on a weekly reversal stop. If it activates the long, use the 1450 level as your stop close only automatically. And if you're long, right, from let's say you get activated at 14, we'll take a look at what the market did in a minute, but it came very close to 1465. And so if you bought that, and I tell my traders, use a 10% margin of error. It will allow you to enter the trade. Unlike most people, most traders that, no, it didn't hit the number, it's not a trade, it didn't act. No. The market, you got to, as a self-directed trader, you got to use your judgment, you got to use your intuition, and you got to use a little room for error. Nothing is perfect except death and taxes in trading, as far as I've learned. And so, if I follow the energy of the market, which is what this does, coming back into like 1465, 60 or close to it, then you can apply your strategy depending on whether you're managing risk, margin risk, or cash value assets. You with me? Whether, you know, that's another argument, another discussion, another coaching lesson as well, in showing you how I take the signal and apply it to triple X velocity derivatives, for example, where I'm making the most money. The futures contract is an ideal instrument to day trade and swing trade if you have the right size, if you can hold on to it. But even so, what I have found is that particularly in a thin market like silver, for example, overnight, they can really drive the market to unrealistic levels that have nothing to, that skew the mean, so to speak, that have nothing to do with its real supply and demand. And so this structure now gave us the analysis as we come into last week. And so what happened last week, obviously, if we take a look at the market action here. The high last week was 1485.80 and the low was 1474.30. And so what the market did is it gave you an opportunity to trade the swing signal that was picked up from 1465 a few weeks ago. It met the target of the mean of 1480. And now we're looking at the weekly, pretty much still on a bullish trend momentum by closing above this weekly average now, and has in place a target of 1486. The daily has in place a sell to target of 1487. Right? So that is saying to you is the ceiling of next week, where the algorithm for next week is showing the highest probability relationship because of the harmonic alignment on the weekly. The daily, the initial is 1484, and then you're looking at the weekly at 1486 and 1487. Okay, so I would say to you that based on this information, that I would start to take profits about 1484, 86, and 87, and probably go neutral next week, or hedge by buying dust. As I said, that's my choice of instrument to stay in the market long term, but to take advantage of short term corrections, intermediate corrections that occur. I use dust, and we will. Well, again, there's a lot of things to kind of talk and discuss, but not necessarily all in one session. What I wanted to do now is just kind of give you prepare you for what the artificial intelligence tells you next week. And so, having the daily and the weekly now, okay, let's take a look at the transformation from last week into this week, and then you can read the algorithm. Okay, so the price closed at let me see, this is 1485, 1481. Average for the 9-day moving average for next week is 1483. So closing below 1483 is still bearish, right? And so let's change this number, 83. So the gold futures contract closed at 1481 on Friday. The market, this I think was the 1030 close that we use. And the market closing below the 9-day moving average of 1483 is confirmation that the weekly trend momentum is bearish. A close above the 9-day moving average would negate the weekly bearish short-term trend to neutral. Okay, so what this did automatically is it changed the artificial intelligence, and it told you 1483 close above next week, it goes neutral on this bearish trend. Okay, so let's do the average for next week, and then we can put it all together. Is 1480. the same information that I use on the charts. With the market closing above the VC weekly here, we got to change this to 1480. It's confirmation that the price momentum is bullish, but it also tells you a close below the VC weekly, it would trigger weekly stops, negate the bullish signal to neutral. So you could put a stop if you're long at 1480. 83 is telling you it's resistance pretty much. And so let's see what the extreme above and below the mean tells us for next week. The V1 level is 1475. You see how it's increasing up. It's making higher lows. And the buy 2 level is 1468. The extreme level, sell 1 level, comes down to 1487. The sell 2 level is 1492. This is the same information that I post in the charts, but this is the language, and I use it because I want to read it, and I read it to myself out loud, and I'll show you why. And this tells you, obviously, you got to change this. And this shows me, as I'm changing, that from 1465 to 1450, the support has increased now to 1475 to 1468. And go long on a weekly reversal stop. If long, you know, if you buy long and at this range, then you use now the 1468 stop. So it's raising the stop. So if you bought the 65 swing, you with me initially on the weekly, your stop now would be at 68 on, you know, on a close below. And your targets obviously are all the way up to 1487. This tells you if long use the 1468 level as a stop, okay, then it tells you close only, but it's got to be on the close and a good till cancel order. On the long side, if it goes above 79, look to take profits at 1487. To 1492 during the week. So it tells you now, look to take profits on shorts into corrections at the buy 1 and buy 2 levels of 1475 to 1468 if activated, and then go long on a weekly reversal stop. Anywhere I said 75 to, you know, you can go long and use a stop at 68, 75 or below. If you're long, and we are because it closed above the average of 1480, take profits at 1487 to 1492 during the week. Another way of looking at it, a little more summary, but this is the language. This is the algorithm actually that transforms this into targets come next week. So, pretty clear structure. The VC PMI stands for the variable changing price momentum indicator.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our variable changing price momentum indicator, VC PMI, is an automated AI trading system developed and tested over a decade. The VC PMI algorithm is based on age-old vortex mathematics combined with Fibonacci, wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VC PMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VC PMI algorithm. The VC PMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VC PMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VC PMI? The VC PMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VC PMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VC PMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.